Coming up today, Chinese stocks continue to rip and head for the best week in a decade on the back of more support for their economy. Why billionaire David Tepper is buying everything China. The Justice Department goes after super microcomputer. The latest from Jay Powell and Janet Yellen. All the knock-on effects to commodities. And is China orchestrating the biggest short squeeze the world has ever seen? It's a massive day, guys. Let's go. Imagine shorting a global liquidity-driven bull market. I'm seeing a lot of pain out there amongst the bears. S&P 500 still ticking higher after a loose Fed, 57.45, sitting at all-time highs. Now we've got the world's second largest economy, China, also becoming very loose and stimulating at the same time. And trust me, that's no coincidence. Stick with me today and I'm going to speak more about that later on and show you all the knock-on effects happening around global financial markets. As once again, it's Chinese securities dominating trading volumes and the headlines. And just look at that candle coming out of the China 50 index in their session yesterday. That's what we call a God candle. My momentum thrust indicator firing off, and this is one of the most explosive moves we've seen in quite a long time. In fact, China on track to have its best week in over a decade, and this has got all the hallmarks of a short squeeze. As the short China trade has been one of the most crowded trades for well over a year now, coupled with record low allocations amongst institutional investors who now look to be doing the mother of all rotation, with China pulling out the big guns and literally dropping helicopter money into the economy, lending money straight to hedge funds to buy stocks, lending money to companies to buy back shares, lowering their interest rates, making it easier for investors to buy second homes, lowering mortgage rates, you name it. And I suspect there is more just around the corner. We may get a big fiscal package coming right from the top from Xi Jinping in the coming days. Next week, they're kind of rolling it out day by day, squeezing the markets after we just got a number of monetary measures. There's the FXI, China Large Cap ETF, also ripping up today. Huge volumes coming into the Chinese Internet ETF, KWEB, up 11.5% today. And one of my favorite Chinese stocks, Alibaba, now back to 3 digits, $105 a share. And just like I'd been saying since late last year, and why I'd been buying the dip in this stock is because it was just incredible value. Down in the low 70s, high 60s, in addition to showing clear signs of technical accumulation. And we are now up 50% off those lows. However, it could still just be the beginning. There's the monthly chart of Alibaba, which has been listed in New York for over a decade now. And in that time, its revenues have gone up more than 10x. However, the stock price is still pretty much the same. This is like the Amazon of China. It still only has a market cap of $225 billion. It wouldn't surprise me if that hits $5 trillion in the next decade or so and even overtakes Amazon in the process. And so Alibaba is not the only Chinese stock I'm invested in. I actually just bought another small cap Chinese stock at the start of this week after I sent out research on it to my paid stock picks members, as I do every Sunday morning. And so if you'd like to also get my weekly stock research, click the link below this video, head on over to my website, clickcapital.io, navigate to the stock picks page, and you can see how my brand new trading account is performing, which I just opened in June, dedicated completely to this stock pick service. And so each week I buy $500 of a new stock, and anytime I sell, I reinvest the funds back into all open positions. And so far so good, the account's doing well. This was updated last Saturday, it's even higher today after we're having another good week, currently beating the S&P 500. And so each Sunday morning I send out an in-depth research report. Palantir Technologies was my first stock pick, currently up over 50%, and I'm still long the stock. There's also a private members area. You can see all details of my open picks, and I paste screenshots from all my trade fills from my new trading account in the private members area as well. Everything 100% transparent, along with a monthly performance report. And unlike pretty much every other so-called trading guru out there who try to encourage you to gamble, day trade, they all have trading memberships, Discord servers, all this stuff, but they'll only send you out vague trading ideas or alerts. There's no verifiable track record, and that's because they're not actually trading their own picks. It's kind of like someone inviting you over for dinner, cooking you a meal, sitting down at the table with you, and then just watching you eat it while they don't eat any themselves. So my goal with this new account is to turn it into over $1 million in under 10 years by dollar cost averaging every week and following my own unique trend following strategy. Stay mostly invested in a diversified portfolio of small caps that are growing really fast. And so if you'd like to join me on this journey, get my weekly research, follow all my live trades, see exactly how my portfolio is performing, then click the link below this video. And for a limited time only, I'm offering 30% off a yearly plan. Once you hit checkout, just use coupon code CHINA and you'll get 30% off the normally priced $9.90 a year and only pay $6.93 a year. Then you'll get immediate access into the private members area. You can see what my latest stock pick was. And like I said, I send out a new weekly stock pick every Sunday morning with my in-depth research as to why I'm buying that stock. And I make all my trades, entries and exits after I send out my picks to members, not before. There's no funny business here. And as far as I can see, this is the only trading membership that has 100% trading transparency. And I actually trade my own picks. So if you're interested in following my portfolio in real time, then click the link below this video and head on over to clickcapital.io and use coupon code China to save 30% off a yearly plan. Okay, just diving back into the charts. We got another rip in the Chinese yuan versus US dollar. And like I said, this is really well timed from the Chinese. It's no coincidence they started making these big moves right after the Fed, even doing these unusual meetings. Xi Jinping chairing up economic meetings in September, which he doesn't normally do. And this is coinciding with a weak US dollar, potentially foreign capital flocking out of the States on political uncertainty, diving bond yields, not to mention US debt also blowing out as well. China could be using this as an opportunity to invite foreign capital back into the country. And that's why we're seeing the yuan appreciate. And so it's not so much that these are huge numbers right now. I think there's more to come. It's more a change in their policy. They were trying not to interfere as much in their economy, and we're actually trying to let capitalism do its job and wash out the weak while keeping the strong. However, it looks like they're tired of seeing their economy and markets going down and down. Now they're copying their Americans and are just looking to print their way out of this mess. Leaders pledging support for fiscal spending, coming out and saying they don't want to see property go down anymore. Plans to issue over $250 billion in special sovereign bonds, coming out with really forceful language, along with actual helicopter money, similar to Ben Bernanke in late 08, early 09. China's just handing out money directly now to people that are going through hardship. That tells me they're worried about social instability. That's the number one mandate. And so now it's time to pull out the big guns. And so that's why we're seeing a huge structural shift in financial markets. Big money getting into Chinese stocks. Hedge funds covering shorts. No doubt a few margin calls being set off. And like I said, they may just be feeding us day by day, and this may go on for another week or two. They don't want to release everything in one day. They really want to turn the tide. First off, in financial markets, get capital flowing again. That's how you really get underneath an economy. You need investment, you need lending. That all flows through to job growth, consumer spending. And I'd say they're also worried about deflationary pressures. And they were on target to grow their economy 5% this year. They're worried that may not be hit. So for them growing their economy at 4.5%, that's a failure, of which a lot of investors around the world consider it the same as well. And the rhetoric I'm seeing from a lot of media, all across media, social media, is that they're scrambling, it's an emergency, the bottom hasn't fell out yet. However, I heard all these same things in late 08, early 09. Then the Fed and the government pulled out the big guns back then as well. And so when central banks and the federal government just flood markets with liquidity and spending, it just squeezes the market higher, just makes the market bigger. It's really hard to step in front of that. Like they say, never fight the Fed and never fight that huge wall of liquidity. And so now we've got the world's two largest economies, the US and China, with ultra loose monetary policy, huge fiscal spending, and both seeking to be very supportive of their market. So that's a global liquidity risk-on regime. Like I said, pretty tough to be a bear in that. And that's why we've got some of the best in the business, like billionaire David Tepper, one of the best hedge fund managers of all time. Like me, he's been long China for over 6 months, and he's only stepping on the gas even more. In fact, he's pushed up his risk limits for what he's allowed in his portfolio. Been doing more buying of late, buying everything he said China. ETFs, futures, stocks, you name it. Saying he was bullish on all aspects of China. With him too, also pointing it pays to be on the same side as a really stimulative government and central bank. And it's true, look at the last two big times the Fed acted. COVID 2020, stock market absolutely exploded to the upside, just like it did in 2009 after they went big the last time. Now China's looking to do the same thing. And Tepper's not the only one either. Big short investor Michael Burry recently bet half his portfolio in Chinese stock. Like Tepper, he's also in Alibaba, Baidu, JD.com, as they were all pretty much on sale late last year into early this year. And we're getting speculation today that China is not printing yuan, they are spending dollars from their reserves for the stimulus. China is de-dollarizing while simultaneously stimulating their markets. It's a genius move, according to this economist. And this comes at a time when the US Federal Reserve has been decreasing their balance sheet overall. Now we've just got big indication from the People's Bank of China they're going to increase theirs. Who knows? They may go vertical like the States did in early 2020. And what a starting valuation we've got. China's still valued at just 40% of US markets, looking at the ratio of forward PE between the MSCI China Index and the S&P 500. Back in the last great bull market China really had, in the mid-2000s, their forward PE actually went above 1.6 as of that of the S&P 500. And it's not just a huge fundamental gap in valuation, also got a monster jaws gap in the technical. Like I said, China's been the only big international stock market that's really diverged from global stock markets over the last couple of years, as their really strict COVID policies have taken a toll on their economy and markets, but only to slow their growth from 7-8% down to 5%, maybe the high 4s. And just like in that last great bull market they had from the early 2000s, going into late 07, it really correlated with a monster move in commodities as well, as China is the world's biggest consumer of commodities. So if China comes back, so will commodities, as they buy more of it and use more of it. And not only will commodities come back, so will most investors, big and small, just like this graphic here says. No one was interested in Alibaba at $66 a share. I actually received a lot of criticism when I was telling people I was buying it when it was dipping down into the low 70. And you can go back and check my daily market reviews from around that time if anybody wants to verify that. However, we're at $105 a share today, and I'd say this is not really going to happen until it goes back to $200 or $300 a share. When it erases all the losses, that's when the crowd usually jumps back in. And like I said, this is big money as well. If you understand how the business kind of works, fund managers have to send out monthly or quarterly reports to their senior managers, their investors, clients. And so when you've got China going down year after year, the headlines are just about as bad as you'll ever see. They don't want to have China showing up in their report. It's just too much career risk. They'd rather just stay away from it, whether it goes up or down. There's no risk for them staying away from it, but there's risk for them getting into it. And that's what creates these valuation premiums. When investors big and small just give up on a sector. So we've got mutual funds at the first percentile of allocations, hedge funds the fourth percentile, and like I said, valuation well below averages as well. And this is the recipe and ingredient for a big short squeeze, a big rotation, and I think that's what we're actually witnessing right in front of us now. Like I said, short interest in the largest traded Chinese ETF in America, FXI, was at records as well. So a lot of them have been getting covered these last couple of days, but it could still have a lot further to run. And like I said, these candles they're printing are simply incredible. Look at the volume. 164 million units traded today. That just a week ago was only averaging 28. Like I said, big money, big short covering, with momentum just taking over and melting up. Turns out yesterday was what I call an entry candle after Tuesday's signal candle. And of course, it's bound to pull back in the short term. However, this type of price action bodes well for the medium long term. And it's spilling over elsewhere as well. We've got South Korea ETF, EW ripping up 5.8% today. They even got Japan bouncing back, up 2.8%. And of course, that's good news for the Australian economy as well. It's highly leveraged to the Chinese economy. Fact is, we've got global equity pretty much everywhere now. Canada's TSX. Germany's DAX ripping up to a brand new all-time high. Even France starting to come back. Singapore's trading really strong. And there's a look at the Vanguard Total World Stock Index, ETF VT. It too also sitting at a brand new all-time high today. So it looks like the everything rally is back. Global markets ripping up, commodities turning, Bitcoin, China exploding, pretty much everything ripping except the US dollar. And so it looks like loose monetary conditions are probably here for the rest of the year. What happens after November in the States could be a different story, of course, depending on who wins as well. We'll see how supportive American policymakers are after November. However, for China, their loose conditions don't look like they're going to be going away anytime soon. And this comes at a time when the US economy is apparently still strong. We're just hearing today it grew at an annual pace of 3% in Q2, which was unchanged from the prior estimate. They just revised it. Forecasts show that a growth rate should come in about the same for the third quarter as well. Goldman Sachs, a few other investment banks, along with the Fed's own forecast, think the US economy is currently on track to grow in Q3 between 2.8 and 3%, which is hardly close to recessionary levels. And if we're also to believe the data we're getting out today, jobless claims sink to a 4-month low. Apparently businesses aren't hiring or firing many people, and that these low level of layoffs are keeping the economy expanding. Of course, we're hearing a much different picture from those on the ground, but the market doesn't trade off what we're hearing from the ground, it trades off the headline prints. Then these departments can come out in the future and revise their numbers, and the market's kind of already forgotten about it because it's so long ago, it doesn't really matter anymore, and it's already digested whatever that news was. And so we heard from Powell and a bunch of others today, and he didn't really talk much about monetary policy, kind of just stayed mum on it, which was a little interesting. May be worried he's cooking things too much, may already consider that he's done his job, put the markets on a sugar high, thought it might be just best to stay silent on it, as we had been looking for signs whether they're going to do another 50 basis point cut. And like I said, if we get any spikes in the VIX anytime soon, I'd say they'd start coming out and hinting at that. So overall, they're very supportive of the markets at the moment, and as long as they hold up, they shouldn't need to come out with much more dovish language unless needed. But Janet Yellen still believes the US economy is on track for a soft landing, that these good conditions will continue, suggesting interest rates will continue to fall, and that it's possible to bring down inflation while also the labour market holds up as well. In other words, all Fed officials, for the here and now at least, are predicting a perfect landing. And it's not just the States and China. We've got global monetary easing. The whole world's gone dovish. Very important, Swiss National Bank just cut their rates by 25 basis points today as well. Bring them down to the low level of 1%. Very stimulative level. A lot of wealth and assets are held in Switzerland. No doubt this is also supportive of global risk on assets. And interestingly, Even though the 2-year is quite flat, we're seeing the 10-year uptick as well. Maybe the bond market starting to release some of that pressure, maybe price in potentially higher prices around the corner. Maybe the economy can hold up, in which it might be back above 4% before we know it. After bottoming out a week and a half ago at 359, it's already slapped on 20 basis points, but the 2-year still pretty heavy, 362, really priced in lower Fed funds rate around the corner. And what has been letting us know pretty much all year that everything is fine is high yield bond continuing to uptrend, outperforming treasuries, and the dollar still trading heavy in this 100 support zone. And like I've been saying all week, I think Bitcoin is primed to rip again. It's a global liquidity proxy, and global liquidity is just shot up, and so I'm expecting Bitcoin to follow suit as well, and we could be back over $70,000 a coin at new all-time highs before we know it as well. What has been doing well lately is PayPal. We just got more news today. They're introducing PayPal Complete Payments in China, supporting Chinese merchants in global sales, helping the Chinese sell around the world. And this is a pretty good move for PayPal. The FinTech has been beaten down for a few years. However, it, along with the entire FinTech industry, looks to be bouncing back. And see that in the daily action of PayPal. Trading up another 3.5% today after it just came out with a good beat in its last earnings. It's having a really good year. And just looking at my fundamental chart on the monthly time frame here, looks like we may have just put in the stage 1 accumulation, going to stage 2 advance. And my indicators have still got it as undervalued. And so like I said, I think FinTech is coming back, and actually one of my most recent stock picks for members is a small cap FinTech that's exposed to China and Southeast Asia, and that's also performing well. And I still think it's got a lot of potential as the global leader in FinTech appears to be coming back. So like I always say, don't get brainwashed by all that bear porn out there. So many fin influencers just want your clicks and views, trying to scare you out of the market, when the truth is the market's full of opportunities. There's so many uptrending sectors and great value out there. And of course, it's never a perfect time to buy. When it's perfect to buy, that's when it's closer to the top. However, throughout all that fear, that is where good returns come from, is getting into good assets before the crowd does. The idea for us small investors, and by small I mean anything under 10 million, is to front run the big money, front run the crowd. That's how you capture big returns. But as always, you should pay attention to the technicals first, fundamentals second. Technicals lead, fundamentals follow. And even though super microcomputer had been really hot this last couple of years, the market was already letting you know that problems are around the corner, and that's what we're hearing today. Justice Department probes Supermicro after a former employee accused the AI server maker of accounting violations, and they're a big customer for Nvidia, so it's a bit of an interesting story, isn't it? If they're cooking the books, some people have been wondering whether Nvidia's orders are all legit as well. The investigations are in the early stages, focusing on allegations. We did see Supermicro delay their latest earnings report, which looked like they may have had to go back and fix a few things. And there's been rumors swirling around this company doing this for quite a few years now. And so it's interesting to see it materialize here today. Down 12%, and how quick it's come off. Just back in March, it was trading above $1,200 a share. We're already down over 67% in that time. And that's why I said follow the technicals first, the fundamentals later. Plenty of opportunity to get out. Maybe on this candle here, or when that candle lost support back around 700, 680. That would have been the time to get out. Instead of waiting and hoping for a bounce, you're always best just to cut your losses and reinvest the funds into something better. And so like I said, what China's doing spills over all across global financial market. Whether you like it or not, it has an effect on your portfolio, even the cost of your everyday goods and services. When commodities go up, so does pretty much the price of everything, as they're a large input into pretty much everything. Still got gold and silver ripping, along with copper as well, for which China imports and uses over 50% of the world's supply, having some strong moves in copper this week. Uranium continued to tick higher, and same with gold and silver as well. Actually broke out today. However, going the other direction, crude oil, still trading really heavy. And this persistent short-term downtrend, now back down to $67.50 a barrel. And that's because we just heard news out of key supplier Saudi Arabia. They're committed to boosting oil output and coming out and saying they're resigning itself to a period of lower prices, dropping their $100 barrel price target, and now going the other way, jumping on board with states and pumping it out at record, while Russia's still trying to pump it out, sell at a discount to China, and demand had been pulling back. However, it appears the supply side's winning over demand at the moment. But if China is going to bounce back, it's hard to see oil going down into the low 60s or further, because if their economy does turn around, they will start using a lot more oil as well. However, nonetheless, it's made energy stocks the weakest sector, and that's been going on for a few months now. You can see that in a really green tape today. Pretty much energy, oil and gas, the really two hit hard sectors. However, we'll be looking for signs of a bottom. May find some support back at those prior lows. And there's the economic calendar for today. Durable goods actually coming in better than expected. Another good sign for the US economy. Jobless claims better than expected. 218 versus 225. Fed speakers still dovish. And then tomorrow, the big one, PCE inflation. Core expected to come in 2.7 year over year, 0.2 month over month. We'll see what sort of read we get on that tomorrow, along with markets reaction, along with how Fed fund futures respond. Currently 50-50, whether they cut 25 or 50 basis points at their next meeting. And just looking across key markets, there's the VIX, still ticking down 15.3, along with volatility risk premium 1.8. Growth versus defensive sectors still bouncing back, along with high beta stocks, and obviously a big bounce back in emerging markets versus American stocks. And there's a look at Apple. Tesla still ticking higher, looking a little stretched here in the short term, and Nvidia actually trading up as well. Along with Intel, climbing higher every day this week, just under $24 a share now, but it's still the energy stocks bouncing around. Pretty weak there. There's Exxon and Chevron. On the other hand, doing a lot better, BHP. Ripping up once again today, 5.5%, along with Rio Tinto, Southern Copper, which I believe is the largest stock in the market that's not in the S&P 500. Huge volume there today. Another copper miner, Freeport-McMoran. Look at that volume coming into these material stocks. Absolute tear. That's big money betting on China coming back. And like I said, this week we've seen defensives have a little pullback, like utilities. My favorite, NextEra Energy, but still pretty close to yearly highs. Also catching a little bit of a bid today, clean energy. Looking at a few ETFs here. Got some good signs of accumulation in solar, along with lithium and battery technology and electric vehicles. Ripping up as well. So there we have it, guys. Once again, China steals the show. Another monster day. Let's see what more stimulus measures we get from them. Maybe a big fiscal package. This could keep going on for the rest of the week, ahead of their celebrations on October the 1st, 75th anniversary, People's Republic of China. But like I said, more importantly than the news headlines we're getting is the price action. The tape doesn't lie, and what we're seeing right now is a monumental rotation short squeeze in Chinese shares. And like I said, if you're interested in finding out what Chinese-related shares I'm investing in that are all listed on the New York Stock Exchange, then click the link below this video and head on over to my website, clickcapital.io. Learn more about my stock pick service, and you're welcome to sign up for a yearly plan and use coupon code CHINA to save 30% off the regular price. Thanks very much for tuning in to Daily Market Review, and I look forward to seeing you again tomorrow. Cheers.